the difference? Time for Ask Annex. Got a question for us? You head to our website, annexwealth.com. Look for the Ask button. And as always, if we can help you, just look for that Get Started button in the studio. Sarah Kyle, a wealth manager at Annex Wealth Management. Hello.
Hello, Danny.
And over to Matt Morzy, investment team manager and a CFP. Welcome to you.
Hey, Danny.
Got a couple good ones. First one is from Tony. I worked in public service my entire career and will receive a nice pension. I haven't done much retirement planning, but saw this on TikTok and it seems too easy. What are your thoughts? To determine income needs in retirement, subtract pension and Social Security, and then divide that by 0.04. Boom. Financial plan.
It sounds real easy.
Right.
I mean, I strongly discourage anybody taking financial planning advice from TikTok. But the rule of thumb is, you shouldn't be taking more than 4% out of your portfolio if you wanted to last your lifetime. That's that 4% rule. So quick rule of thumb is you can multiply your annual spending by 25. That's what your savings should be in order to withdraw 4% out of your account per year.
But it's way more complex than that.
Yeah, and he mentions he wants to determine his income needs. Well, your income needs are based on your spending.
Remember a couple of weeks ago, somebody saw on TikTok that you maybe should get a baby a credit card. So this would be the second strike. Don't get your financial advice from TikTok.
Exactly.
Yeah. Next one is from Ken. What is a Santa Claus rally?
Yeah, great question, Danny, and thanks, Ken, for putting that in there. This is one of those things that I always kind of find funny. As you look through the calendar year, there's different months or weeks or time periods that you could rhyme different things off and get to whether or not the market should go up or down during that time period. But when looking at those, the Santa Claus rally, which is loosely defined as the last 5 trading days of the year and the first of the next 2, historically have actually worked out really well. Since 1950, that time period has been up on average 1.3% over that 7 days and up 75% of the time, which when you look at a normal 7-day trading period, the average is up 0.24%. So you're getting an extra 1% over a week of trading, which is pretty spectacular. And it's only up 58% of the time normally. So historically, it's actually worked out really well. You never really know why these things kind of happen the way that they do, but the kind of general thoughts is that week between Christmas and New Year's and going into the years, many people take off during that time period. So you have low volumes during that time period. It doesn't take as much to move the market as it normally does, but you also have a lot of hopeful and optimistic thoughts with Christmas going on, New Year's, the anticipation for the next year. I would think in a year like this where it's been a pretty negative year that people are looking for something optimistic. So maybe we do get one, maybe we don't. And it also sometimes can be self-fulfilling. It usually goes up during this time period, so I'm going to buy because it usually goes up and then it goes up and then people start to extrapolate that over time. But it's always one of those funny ones to look at.
Next up from Ed, with short-term rates higher than long-term rates, why wouldn't I only buy shorter ones? That's the problem with the inverted yield curve, right?
It is. And when you have a 1 or 2 year treasury that's earning more than a 10-year treasury, we get that question a lot. And a couple of things that we look at is, well, first of all, what's your reinvestment risk, which is essentially that if you invest for 1 or 2 years, you now need to find a new investment when that bond matures. And what will yields look like at that point in time? With the yield curve being inverted as it is now, the market's telling you that the rates are going to be lower in the future. And so that your ability to roll that over and still be able to make up what you could get on a longer term bond right now is probably not going to happen. And that's why it's showing you that. Well, we're going into what we've called it, what we've heard is the most anticipated recession of all time. And if that does happen to play itself out, the Fed will likely be cutting rates. And so in 2 years from now, when your bond matures, you're looking for something out there. If the Fed's been cutting, you're going to get something less. And ultimately, what we want to do is diversify upon that yield curve. You want to have different parts of your portfolio at different parts so that you can counteract that risk.
Yeah, and what we like to do with clients is what we call a bond laddering. So you take different time frames and buy different maturities and bonds and kind of diversify that way over the duration.
That's kind of a classic thing, isn't it? The bond ladder? Mm-hmm. Been around a long, long time. Our last question is from Omar. Are I bonds still worth looking at?
Sure. Currently, they're paying about 6.89%, but that will reset in May of 2023. They reset twice a year. But just keep in mind, they're not super liquid. So for the first 12 months, they are illiquid, and then they mature after 5 years. And you're only limited to buying 10,000 per year. So if you're worried about liquidity, you might want to look at other government interests, like we mentioned, the treasury bonds. But if you don't need the liquidity and you can hold it 5 years, then it might be something to look at.